subscribe.
Good morning, all you magnificent melon heads out there. Happy Tuesday, everybody. Today is August 22nd, 2023. And a big story this morning, the banks downgraded yet again. Another bank downgrade. This time it's S&P Global jumping on the bank downgrade beatdown, kicking them when they're already down. We had 5 regional banks were downgraded this morning. Reasons cited included funding costs. We had commercial real estate was mentioned. We had deposit flight was mentioned. We had, what was the other one? Brokered deposits was mentioned. Brokered deposits was when the banks just actually go and buy deposits from other banks. They bid up the interest rates. It's a sign of a bank being desperate for liquidity. We need new money coming in to be able to meet withdrawals elsewhere. So the 5 banks downgraded were Associated Bank Corp, ticker ASB, Valley National Bank Corp, I believe that's VLY was the ticker on that. UMB Financial, UMBF, and Comerica Bank, CMA, and Key Corp, ticker KEY. 5 regional banks downgraded for multiple reasons. So this is on top of downgrades from Fitch recently. The U.S. credit rating was downgraded at Fitch. Fannie and Freddie were downgraded at Fitch. We had Moody's downgraded 10 banks about 2 weeks ago. We had another one, I think it was Fitch, who warned that they might have to downgrade the whole sector, which would mean we'd be downgrading JP Morgan and Bank of America. So guys, the banks are still a thing. I get it, March was months ago, and oh my goodness, it's been like a whole week since a bank has failed. Remember Farmington Bank, that's a failed bank. They didn't say it was a failed bank. They said it was sold, but we dug into the balance sheet with that video I did last week. That bank failed. All right, Kansas, what was it? Heartland Tri-State Bank didn't fail for any of the reasons we're talking about here today. That was a scam that took that bank down. We still don't know what the scam was. The authorities are hush-hush on what happened at that tiny little bank in Kansas. But that was another bank that failed. Guys, banks are still going down, and they're still getting weaker. And the ratings agencies who were caught sleeping in the global financial crisis, remember that scene in The Big Short with the lady, where is it? Hold on, I've got it. It was one of my favorite scenes in The Big Short because they did this. There she is. Remember this gal from The Big Short? I love that scene. Oh, I have to like look around her. I love the literary tools they use here. You know, she's blind, she's asleep, she can't see what's going on. You know, they put the glasses on her. You know, I doubt that the woman who worked at S&P really had those glasses on. It was just a literary device. The same thing with the SEC, the girl who worked at the SEC when she was in Vegas. She was literally in bed with the guy at Goldman Sachs, get it, the regulators in bed with the bank. That movie was so great, the way they put these subtle messages in there. But the ratings agencies don't want to be caught up in that again. And so once the floodgates were open, once somebody pulled the cord, and it was Fitch with the downgrade of the U.S. credit rating, once that started, all the other ratings agencies said, well, the competition is downgrading somebody. I guess we better do it too, right? Yeah, oh, that's right, Johnson. That's a great idea. Start downgrading some banks. Go find me one. And now they're just piling on. And by the way, that's all warranted. All the reasons they're citing are valid. The risks on these balance sheets that are out there are tremendous. And the big banks are just loving life right now because they see a bunch of little banks getting downgraded. They know their funding costs are going up, and that makes those banks more likely to sell themselves at a discount to their big monolithic mega bank cousins who would just love to devour them. So we've got that one going on today. Also, something interesting happened yesterday. We had the stock market ripped yesterday, in particular the NASDAQ. Nvidia was up like 8.5%. But at the same time, the 10-year yield was rising sharply yesterday. The two of those shouldn't be happening at the same time. All right, with the 10-year yield at highs we haven't seen since 2007, we shouldn't see stocks rallying while yields are blowing out. Not in a zombie economy, a debt-based economy. So what stock investors are doing right now is they're betting that the 10-year yield is putting in a double top and that it's going to start heading lower. And I don't think they really thought this out. All right, because that might happen. It could, but remember the U.S. Treasury is going to start issuing more long-duration bonds. Issuing more supply, prices go down, prices and interest rates inversely correlated, so the Treasury issuing more of these long bonds is going to send long-end interest rates higher. Now, in the last few months, since the debt ceiling, they've been issuing mostly T-bills, short-duration stuff, the 1 month, the 3 month. And the money from the reverse repo has come out in order to fill that funding need for the government. And so we haven't really seen short duration interest rates blow out like we thought they would because reverse repo came to the rescue. Reverse repo will not do that for 10-year treasuries. It won't do that for 30-year treasuries. All right, money market funds don't invest in the long stuff. They keep it in the short stuff because you may need access to that money in short duration. So the market is betting on a downward revision on a downward slide in interest rates right now. The Fed is not going to provide it. No way. Not with stock market valuations where they are, not with unemployment being as low as it is. The Fed is not going to cut anytime soon. They just won't do it. So why would interest rates head lower? Well, a panic, a flight to safety. But if there's a panic and a flight to safety into the 10-year yield, people running to bonds for safe haven, you don't want to be caught holding Nvidia stock in that environment. That's the worst possible exposure. So I'm not really sure what equity investors are looking at here as they're piling into this while the 10-year yield rises. And guys, the worst case scenario, what if there is a flight to safety? And I talked about this, shout out to my buddy Keenan over in the Patreon group. We were talking about this last night in a couple of email messages. What if the flight to safety is from the 10-year yield? What if we're not putting in a double top right now? What if, like my moderator Mish mentioned this morning in our phone call, what if the 10-year yield is just completing a bull flag right now and it's about to break out big time to the upside? What if there's a stampede for the exits, but it's actually out of the bond market, meaning sending yields in the other direction? Well, you damn well don't want to be holding stocks if that happens. So Nvidia stock is running. It's up again big this morning, another 2.5%. Maybe the few people who shorted Nvidia stock are being squeezed right now and being forced to buy, but the short interest in Nvidia isn't really that high, which, by the way, shorting a mania stock, ill-advised. My gut tells me Nvidia is in for a major, major correction to the downside. That being said, never short a mania, guys, because ask Melvin Capital how that went. All right? When you're short something that is going vertically up for no reason, you might be right, but you're going to get killed before you're proven right. And lastly, Dick's Sporting Goods reported today. What a mess in Dick's Sporting Goods numbers. Profit down 23% year over year, big earnings miss, small revenue miss. They lowered their guidance. The comps were 1.8% up year over year. That's not even keeping pace with inflation. But the big thing they mentioned on their conference call, both the CEO and the board chairman mentioned inventory shrink. Wholesale retail theft took a big chunk out of Dick's profit margins right now, enough that they're blaming their quarter on it. This problem is getting out of control. People are just walking into stores all across the country, taking whatever they want unmolested and leaving the store with hundreds of dollars, thousands of dollars worth of stuff. In some cases, flash mobs are doing this. They're just looting the store while everybody sits there and watches. Nobody gets arrested. Nobody gets prosecuted. No, nothing. How do you do business in that environment? How does any retailer do business when at any moment a mob can walk in and with no fear just clean you out? Who is paying for that? That took a big chunk out of Dick's earnings today. And with that, let's shrink my big melon of a head. And while we're shrinking my melon of a head, won't you please inflate that like button, everybody? It really helps me out for the YouTube algorithm. And if you're new to the channel, won't you stay a while? We do this every morning. CNN Fear Greed Index right now sitting at 46, still in neutral territory, up from the just barely into fear that we were a few days ago, but sitting in pretty much neutral territory. The market could go in either direction from here. The S&P this morning is looking like it's going to open up about 18 points higher. That's about 0.4% to the upside. The Dow is up about 35 points pre-market, looking like a 0.1% increase, although right now it looks like it's bleeding off a little bit of those pre-market gains. By the time the bell rings, we'll see where we are in the Dow. But the NASDAQ, look at the NASDAQ, up again, 0.67%, another 100 points after a 200-point rise yesterday on what? Hopium. That's all. Just basically hopium. Maybe hypium. I don't know, hopium and hypium. That's why the NASDAQ was up yesterday. The DXY is up higher too. Again, yields going higher, DXY going higher, stocks going higher. Doesn't work that way, guys. Something's got to change. Something's got to reverse here. The DXY is up another 17 basis points this morning, 103.47. And guys, take a look at the chart on the DXY right now. This is going back to about the middle of March. And I just want to show you a little bit as we go through here. We had a reversal in July. We came up, we broke above the 50-day moving average. That's a major technical event. We failed the first retest, but we popped back above. And then we passed the retest. Now we're onward and upward. Now we're up to the 200-day moving average. And check it out. 1, 2, 3, 4 retests of the 200-day moving average. The 200 line is now acting as support where it was previously resistance. That's telling me that the DXY is looking to head higher here. All right, now that's just on a technical basis right now. It really looks like the Dixie's looking to break out to the upside. That would be majorly bearish stocks. The one asterisk there is watch that Bank of Japan. If the BOJ starts defending the yen by dumping U.S. debt and dumping U.S. dollars, that is going to put upward pressure on interest rates, on bond yields, and it's going to put downward pressure on the DXY. So keep an eye on what the BOJ does from here. It could throw this whole chart out of whack. And the last time the BOJ started defending, that was back around when the DXY was around here. So the BOJ defending can send the dollar lower. Looking over at bonds, we got yields are mostly higher this morning. What did I do? I lost my chart. Give me back my chart. There we go. All right, U.S. We've got the 30-year Treasury is flat at 4.46 this morning. We've also got the 10-year yield is up just about 1 basis point, 4.34 on the 10-year Treasury. The 2-year, look at that, a 5 handle on the 2-year, guys. 5.01% on the 2-year Treasury. The highest that has been since 2007, since pre-GFC. Think about how much more debt there is now than there was in 2007 in all facets of the economy. Mortgage, credit card, car loans, business loans, the national debt. Now that interest rate is exactly where it was, 15 years ago, 16 years ago. 5% on the 2-year. That's up 2 basis points. And the 1 month is flat at 5.38 this morning. Now, guys, I mentioned that the market was betting on a double top in the 10-year. This is the 10-year going back to about October of 2021. Look, we had that monster run all through 2022, right? Now, we topped out in November when we put in this level here. We came back down. We consolidated. Now, as my moderator Mish pointed out, that could have been the bull flag right there. Now we're back up here right to this point. Now, stock investors right now, all the people FOMOing into Nvidia are betting that the Fed is done and that rate cuts are coming and interest rates are heading lower. They're betting that we're going to head down back here. All right. And when you put in a double top, which is what this would be, is a double top pattern, the move is typically about double the distance between the peak and the valley. All right. Which would put us somewhere around here, around 2% on the 10-year. The problem is we've already broken above that prior high. So what if it's not that we're heading for? What if we're heading way to the upside off the corner of the screen here? In that case, what if this is a bull flag? That would mean the 10-year is going to march higher and higher. And look, all the biggest holders of 10-year treasuries right now, the Federal Reserve, the Bank of Japan, the People's Bank of China, they're all sellers. So all the pressure on bonds is downward in price and upward in interest rates. So where are the new buyers going to come from in order to start bidding up these 10-year bonds and sending the interest rates lower? And I would add that there's more supply hitting the market because Janet Yellen has said she's going to start issuing more long-duration bonds. So where are these buyers going to come from? Typically, the only way you get massive amount of buying from the public sector, from private investors, is in a flight to safety. And in that environment, you don't want to be holding tech stocks. So I'm not really sure I'm seeing in the charts what Nvidia stockholders are seeing in the charts right now. Looking over at commodities, we've got gold is at 1,924 for December futures. That's up $1.70. September silver futures are up about a nickel this morning, or 0.6% at 23.40. We had a good day for silver yesterday. WTI crude oil October futures are trading at $80, just over that 80 mark, down about a dime this morning, or 0.49%. Not a lot of movement happening in the commodity space. Let's talk about the bank downgrades, guys, because this is the biggest story this morning. S&P downgrades multiple U.S. banks on growing liquidity worries. That liquidity word. Danger, Will Robinson. That you got to watch out for. Liquidity means sudden spike in interest rates. All right? That means shortage of cash, dollar shortage. Banks who have them stop lending. Those who have dollars survive. Those who don't have dollars die. All right, so that's what S&P is warning about right now. S&P Global cut its credit ratings and outlook on multiple U.S. regional banks on Monday, saying higher funding costs and troubles in the commercial real estate sector would likely test their credit strength. A sharp rise in interest rates by the U.S. Federal Reserve is fueling liquidity concerns as costs tied to funding deposits surge, the S&P said in a summarized note. The agency cut its ratings on Associated Bancorp, Valley National Bank, on funding risks and higher reliance on broker deposits. All right, funding risks means they've had to borrow expensive money, like from Federal Home Loan Banks or from the Bank Term Funding Program or even the Fed's discount window. That's expensive money that the banks are borrowing to meet deposit withdrawals. Well, if they're paying higher interest on the money they're borrowing than they're earning in interest from their loans, well, then those banks are losing money. Their profits are getting squeezed. So that's why this bank is getting, or these two banks are getting downgraded on that. Now, the other thing I would mention is that they're being downgraded on brokered deposits. There's a word there, brokered deposits. That's when they actually go out and buy deposits from other banks. And again, brokered deposits, you have this third party involved who says, hey, I've got these deposits at these other banks. Maybe their balance sheet looks better. I'm willing to sell them to you, but what kind of interest rate can you give me? So these banks end up having to outbid the competition to get these brokered deposits. Again, it's very expensive money that they're taking in. And if they're paying more in interest than they're earning in the loans, the banks are slowly going under. Other downgrades included UMB Financial, Comerica Bank, and KeyCorp. They were downgraded for large deposit outflows and prevailing higher interest rates. And there was a time, guys, when higher interest rates was very good for banks. Typically, banks do really good in a rising rate environment, but not when loans are going south, not when people are starting to default, not when they have to pay higher interest rates on their short-term deposits than they're earning in their long-term lending. So this is not a good environment for banks. And there's that phrase, large deposit outflows. Well, that sounds a little bit like a bank run, doesn't it? And that's a word that pretty soon I'm going to have to stop using in my live streams and in my videos because I have the feeling that's going to be the next thing that we get censored on. Anybody saying bank run, they won't show you to anybody because they're trying to calm down markets. Don't put it past they, guys. They will censor financial content if things get bad enough. That's also why you need to follow me at Twitter, which there's a link to my Twitter feed in the About Me page of my channel, at JGNuke on Twitter. Less censorship over on that platform. KeyCorp shares were down marginally in pre-market trading. The outlook of S&T Bank and River City Bank were also cut to negative from stable by S&P, citing higher commercial real estate exposure. CRE is still a big thing going on in the U.S. economy, guys. I know I've been talking a lot about China and the housing collapse over there. We have a smaller but equally serious problem here in the States with commercial real estate, and it's mostly small and regional banks that are exposed to commercial real estate. The agency's action will make borrowing costlier for the ailing banking sector that is looking to shake off effects of the crisis from earlier this year when the collapse of Silicon Valley and Signature Bank sparked a loss of confidence and led to a run on deposits at several regional lenders. Borrowing costs globally have also surged, with the U.S. Treasury yields hitting their highest in 16 years as the bond market rout entered its sixth week on Tuesday, even as U.S. stock index futures gained, boosted by mega cap growth stocks, aka the FOMO bros piling into Nvidia. Moody's had earlier this month cut its ratings on 10 U.S. banks by a notch and placed 6, including Bank of New York Mellon, U.S. Bancorp, State Street, and Truist Financial, on review for potential downgrades. An analyst at Fitch, the last of the 3 chief ratings agencies, also told CNBC last week that several U.S. banks, including JP Morgan Chase, could see downgrades if the sector's operating environment were to deteriorate further. Fitch is saying we're going to downgrade the whole sector. We might have to do that. And if that's the case, even JP Morgan's going to get a downgrade. So the ratings agencies are really piling onto the banks. And let's just take a look at a couple of these. Here's Associated Bank. That's one of the ones that was mentioned. They're down about 0.5% pre-market. We've got Valley National Bancorp, ticker VLY. They're not even moving pre-market. UMBF, that's UMB Financial. They're unchanged pre-market. Let's refresh this and make sure I'm still getting accurate data. I am. Comerica is down about 1.4% pre-market, ticker CMA. And KeyBank, they're down about 1.5% pre-market, ticker KEY. So all these banks are either flat or down on this news. Watch out for little banks, guys. Lesson learned, the thing that started in March with Silicon Valley Bank, it definitely, the peak is behind us of that, but that story is not over. These small banks are still struggling. Nothing has changed for them. Now let's talk about Dick's Sporting Goods, because this is worrying for just about the whole retail sector. We're hearing how the consumer is strong, retail sales were so good. And keep in mind, sporting goods was one of the categories in the retail sales report that we got last week or 2 weeks ago. I forget, the weeks are blurring together. But sporting goods was one of the highlights in that retail sales report. And this information from Dick's flies in the face of that. Dick's shares fall 20% as retailer slashes outlook over theft concerns. Dick's Sporting Goods reported a profit drop and cut its earnings outlook for the year after seeing an uptick in retail theft and slow sales in its outdoor category. In its first reference, the athletic goods retailer has made to shrink in a press release in nearly 20 years. All right, let's talk about some of the highlights from the numbers here. Profit down 23% year over year. Keep in mind, guys, stocks are up, profits are down. That means stocks are getting more expensive. 23% year over year. That is not a small downturn in profits, guys. That is a huge miss on profits. Earnings per share were $2.82 versus $3.81 expected. Not a small miss. That's a big miss from Dick's. Revenue was $3.22 billion versus $3.24 billion expected. So a small miss on revenue, a big miss on earnings. What does that mean? That means profit margins are getting squeezed, guys. Dick's profit margins went from 36% last quarter to 34% this quarter, and they're blaming retail theft for the squeeze in profit margins. How much stuff has to get stolen for a company the size of Dick's Sporting Goods to take a 2% hit in their profit margins? You have no idea. Guys, the theft problem, it's massive. There is so much stuff is just growing legs and walking out the door right now. They lowered their guidance. Comparable same-store sales were 1.8% up year over year. That's not even keeping pace with the rate of inflation. Oh, and they cut 1% of their corporate workforce. About 250 people at Dick's are going to lose their jobs. Now, I want to just give you these quotes here from some of their executives. This is CEO Lauren Hobart said in the news release, "Our Q2 profitability was short of our expectations, due in large part to the impact of elevated inventory shrink, an increasingly serious issue impacting many retailers. Inventory shrink is a polite way of saying people are stealing too much stuff from our stores." It's so much better. Inventory shrink. It almost sounds like a positive when you put it there. Oh, the inventory just shrunk a little bit. No, crowds of people came in, took whatever the heck they wanted, and walked out without paying for it, and our profit margins are getting crushed from it. That's the CEO. But let's also talk about what the board chairman said about a third of its margin reduction was from shrink. And here's what he's saying. It's moved. It's kind of gone up. We expect it could even get a little bit worse. We've taken a little bit bigger reserve for that in the second half of the year, just because what we see going on with organized retail crime, grab and goes. We think we're doing the best we can to try to curtail it with the security that we have in the stores and working with local authorities. And I don't see the point. They're saying we're going to work with local authorities who won't arrest people. Prosecutors won't prosecute them as long as they steal less than $1,000 worth of stuff each. So you have a crowd of 100 people goes in and everybody takes $900 worth of stuff. Well, nobody gets prosecuted. So I don't know how security and working with local authorities is going to help Dick's in this regard. Dick's stock this morning getting crushed pre-market, down 20% on this story. And last but not least, guys, Nvidia stock. WTF Nvidia stock. Yesterday up 8.5%. Today up another 2.7% pre-market. This thing has a $1.16 trillion market cap, a price-to-earnings ratio of 243. Guys, the S&P average PE is something like 23 right now, or 24. And you've got this thing is trading at 243 times earnings. Okay, so profits at Nvidia need to grow immensely just to keep the stock price where it's currently at. All right, so if profits at Nvidia surge higher, the stock won't go up because it's already gone up anticipating that, which means if they don't deliver on that growth, this stock is going to get crushed in a big way. If there's no growth, this 243 times PE ratio is going to revert back to something closer to the rest of the S&P. And they're starting to smell that out in Yahoo Finance this morning. Nvidia stock hype is out of control, meaning investors might be overlooking this one key risk. This is from Brian Sazi over at Yahoo Finance. The bulls are so blinded by the AI hype around Nvidia ahead of its earnings this week, they may be forgetting one important ingredient to the story. If Nvidia can't make enough of its hot in-demand AI chips that power large language models, then it probably can't meet the ever-rising profit expectations of Wall Street. And if that's the case, the Nvidia hype balloon may pop. Nvidia expectations have been steadily moving higher in recent weeks, and the investor debate appears centered on supply rather than demand. That's according to Stifel analyst Ruben Roy. Roy added that supply concerns and its near-term impact on Nvidia's guidance are top of mind. So bad things coming in Nvidia stock if they're unable to deliver on this. And the last thing I want to mention, guys, is the Stock Pulse Silver Symposium is just 38 days away at Caesars Palace in beautiful Las Vegas. Come on out to the Silver Symposium. I'm going to be speaking on that Sunday. I'll be talking all about what's going on in China, a continuation of the talk I gave last year. If you went to the Silver Symposium last year and you saw my talk on China, then you knew all about this economic collapse going on in China. You would have seen it coming way ahead of the pack. I'll be talking more about that this year. Joe Brown from Heresy Financial, the Economic Ninja, Dan from I Allegedly, Andy Scheckman, David Morgan, Chris Taylor from Financial Prepper. All your favorite YouTubers are going to be there. This is a fantastic event at a great venue this year. So grab your tickets. There's an affiliate link in the description down below. If you use that link, you will get 10% off of your tickets. And I got a couple of thank yous I got to say this morning. Thank you guys very much in the comments here. What's going on? Mr. Jose Orozco says, hit that like button, everyone, right now. Nice Super Troopers reference you got there, Jose. If you're going to challenge me on movies, you're going to have to do better than Super Troopers. I've seen them all, brother. Right now, I need you to hit that like button, everybody. Thank you very much, Jose. I appreciate that. Thank you for the super chat. Thank you for the algo boost from all those likes that are probably rolling in right now as we speak, thanks to your reminder. I appreciate that very much, guys. It really does help with the algorithm when you hit that thumbs up button. And when you share this with other people, that really helps as well. Steve Woitis, thank you, sir. Theft, while an indicator of lax prosecution, can also be an indicator of unaffordability. Absolutely. Absolutely, Steve. When people have no hope, have no options via legitimate means, well, people pursue illegitimate means. Abso-freaking-lutely. And, economic prosperity, when it goes away, a lot of people turn to crime out of desperation. Some of them are just dirtbags. Some of these are people who are just going to beat, rob, and steal no matter what the economy does. But a lot of these are people who just have no other option. And they're turning to crime because they're desperate. And when you have high inflation, and then when the Fed comes in and they say, oh, no, we need to slam the brakes on the economy and put everybody out of work before the wages go up to compensate for that rise in inflation. And then they're like, gee, I don't know why people are stealing. No, maybe people are stealing because you, Jay Powell, and all your cronies at the Fed and in the banking system, you stole from them. And that's exactly what you did. Maybe it was legal what you did. Maybe it wasn't. I'm not a law professor. But when you printed trillions of dollars and bought assets, inflating the value of stuff that you already own, remember when you sold your stocks right before the big crash in 2022 or summer of 21, you sold your stocks to eliminate the appearance of a conflict of interest after you had already made immense profits on those stocks? That was theft. You stole that wealth from people who hold dollars. A lot of those people who are right now stealing from Dick's Sporting Goods. Now, I'm not condoning the theft at either end. I'm not condoning retail crime. I'm not condoning the money printing. But theft is theft. And they, with a capital T, stole from everybody, and a lot of people are stealing back. I understand the anger. All right? I'm not condoning it. I'm not excusing it. But let's be honest, folks, that's why. People are stealing in large numbers for the same reason people are living in freaking tents from large numbers, because they have destroyed the currency. They have stolen the value from the currency, which means the people who had the currency are poorer than before. And remember, that first chart on WTF happened in 1971. The gap between the two, it continues to grow because of this cycle of inflation and then rate hikes to stomp out any wage growth. Thank you very much, Steve Woitis. I appreciate the super chat, the support of the channel, brother. And thank you, everybody, for your time this morning. We've got the opening bell in just a couple of seconds here. So thank you very much for your time this morning. Thank you for the super chats. Thank you to my Patreon supporters for everything you guys do for the channel. Looking forward to talking to you guys tomorrow on our weekly Zoom call. Link down below should you feel so inclined. Hi, Mom. Hi, Dad. I love you guys. Till next time, live small and dream big.